Well, hello there. SEBI has floated a 40-page consultation paper wherein it's proposed in a uniformity coming in on the total expense ratio for all the mutual fund schemes out there. A bunch of analysts and the broker company and the advisors and the AMCs have been talking about it through the course of the day. The proposal only is to enhance the transparency in the cost chart to unit holders. It suggests that the TR should be inclusive of all the expenses permitted to be charged to an investor. Now, to take the discussion forward, we've been joined by the guest out there, Anant Ladha, CFA CA LL.B founder of also Feroze Azeez of Anand Rathi Wealth and Avinash Luthria, the SEBI RIA for fiduciary in. Hello there, gentlemen. I'm going to start off by asking Feroze to you first. What do you make out of this development? SEBI wants to charge, SEBI wants AMCs to charge all the additional expenses within TER to encourage uniformity and transparency. It should be calculated perhaps on the AMC level instead of scheme level. What do you make out of this proposal out there?
Of course, Nikki, there is a lot of dwelling it needs, but from a 38,000 feet, I think there are three things. SEBI is trying to achieve three objectives. One is transparency, point one. Two is reduction in cost. Three, curb mis-selling. I personally think these are the three things which SEBI must have written down the objective before it put the paper out. So coming back from a distributor standpoint, I see this as one benefit that SEBI wants to make it holistic. See, it's very important for an asset management company or a distribution fraternity or an advisor fraternity to know all of it together. Every 6 months, one change in regulation requires recalibrating one's business. So I think I'm very, very happy that it's exhaustive. And like you said, it's a 40-page report. That's a brilliant news. Because you're taking not one thing at a time. You're taking all of it at a time and addressing it. And after 3 years, you come back with some changes rather than in piecemeal. So that's point one. Point two, there's consistency in all the circulars. If you try and read all of them over the last 3, 4, 5 years, there's consistency. I love the consistency bit. I like the holistic bit. Of course, there are some things which actually could be counterintuitive to the objective which SEBI wants to achieve. Those need to be deliberated a little more deeply. Optically, what you think will solve the problem can also have an amplification to the problem which you're trying to solve in the first place.
All right, Anand, I'm going to come to you next and I'm going to ask you about what do you think from the AMC standpoint. Of course, for unit holders, we'll get to the discussion on the later part of the show. But just from an AMC point of view, do you think this will actually lead to a margin hit coming in for these AMC guys who will probably charge higher DER to the equity and the hybrid oriented schemes more than they could for the debt level schemes? Your assessment. And now, having said that, do you think apart from margin now, the game will be volume game rather than a margin game? How do you look at it?
Hi, Nikki. Firstly, thank you so much for having me on the show. See, first, let us understanding the objective behind this complete thing. Objective is that smaller AMCs should have an edge. They should be able to charge higher expense ratio as compared to the bigger AMCs. But let us what will actually happen. Basically, two things can happen. First interpretation can be that smaller AMCs will have an edge and they will be able to perform better. Second, different perspective is just because smaller AMCs will charge higher expense ratios as compared to the larger AMCs, bigger flows, especially the institution flows, will now start flowing towards the bigger AMCs because of margin of economies. So this is something which need to be addressed and which needs to be thought about, because the basic objective of making a slab-wise expense ratio is that basic objective is to benefit the smaller AMCs. But in result, I personally feel that larger AMCs will be at a better stage because any which ways they have larger AUMs and they will be attracting more volumes, which will be the key going forward. Also, from investors' perspective, obviously it is good if something is becoming cheap. Obviously, investors will enjoy and they will be benefited.
Sure, I have an argument to that because it's not really as per what we see, right? There are over and above. At the present moment, given the slab that we have, AMCs are allowed to charge for 4 additional expenses. The first one is the brokerage and the transaction cost. Second one is the TER for distribution commissions for B30, that is beyond 30 cities. GST and exit load. Do you think by virtue of that, the incentive of TER to distribution commission, that will probably take a hit, and there'll be lesser motive, incentive to go out there and sell the plan to the unit holders, because of which this will take a hit? Uh, your assessment overall about it.
See, firstly, let me divide this part in equity and debt. If we talk about debt, there won't be much impact because any which ways, all the expense ratios which are being charged by bigger AMCs is already within the limit. So debt as such won't be impacted much. If we talk about equity, yes, there will be hit for distributors and for AMCs both. But I think that this was something which was already it was expected that it is bound to happen sooner or later. So I think AMCs, at least the bigger ones, were already prepared for it. But yes, there will be hit for bigger AMCs.
All right, Avinash, to you next. I'm just going to ask you about your assessment, because TER for the debt schemes out there, correct me here if I'm wrong, is way lower than that of equity. That's because of the economies of scale enjoyed and the bargaining power that most of the corporate side clients have, who are mostly invested in the debt schemes. So, does that mean more amount of a disruption coming in for the equity, or probably inflows coming in for the equity and the hybrid segment out there? How do you look at it?
So let me just give you my big picture view of how I see this change. I see it as, abstract from all of it. What's happening is the most important change was, let's say earlier there were two schemes, a scheme with large assets under management and a scheme which had small assets under management. The scheme with large assets under management had a, say, 1.5% expense ratio. The small scheme had a 2.5. The very vigilant investors or customers were going into the scheme with the low expense ratio. The less vigilant ones were going to the one with the high expense ratio, say 1.5 and 2.5%, let's say. SEBI has just said charge 2% for both the schemes in a simple sense. I'm oversimplifying. I think that's an overall positive, even if it doesn't make any difference to the AMC. It just means that the less vigilant customer is less hurt now. Everybody pays the same fee, and there's not some arbitrage by, if you're very vigilant, you get a benefit, and if you're not vigilant, you get hurt. Coming to your question, I don't think there's that much room to play around between the debt and equity schemes, because as you mentioned, the institutions and corporates are investing in some of the schemes, but actually more institutions and corporates are investing primarily in overnight funds, which are actually not impacted very much by these regulations. So I don't think there's much scope for the AMC to play that offset. But I think this is a great positive that everyone pays the same. It's not that if you're careless, you'll end up getting hurt badly.
Sure. Feroze, what do you make out of it in terms of a blanket benefit coming in for the unit holders of these schemes, which will probably see uniformity and thereby the reduction in TER? Your assessment on that, and also for the the AMCs, clearly they're going to take a hit in terms of their margins. Do you think now they're going to be focusing more with that? It's going to be a volume game out there.
Yes, surely, Nikki. Firstly, I think we should all debate the investor perspective first, because all four of us will be investors for sure. We are not AMCs, none of us are, I believe. So, point I'm trying to make is investors' biggest risk is as follows. To my mind, if an AMC which has up to 5,000 crores of equity assets has a 2.55 as the TER in the table given in the circular or the consultation paper. Now, if you look at the largest AMC, all its schemes, if the back of the envelope computation is done, is going to be SBI Schemes, which is the largest asset management company you're speaking about, 1.42 as the total TER. If there's one AMC which can charge 2.55 and the largest AMC is going to be 1.42, the problem which I see for the unit holder and the risk I see of this getting implemented for the unit holder is somebody was giving a wrong advice between NFO and other schemes. The same person will give wrong advice in terms of scheme AMC choice. All right. So mis-selling could happen in distributors or anybody giving advice to a small retail investor to go for smaller AMCs. And that will actually create money moving from a large AMC, not on the merit basis, but on the basis of commission, it can move from large AMCs to smaller AMCs, which I think is the same problem you currently have when SEBI has cited 86,000 crores of NFO money. 27%, 77% of that was switched from one scheme to the NFO. If that can happen for commission, what stops a distributor who has malice in terms of inclination towards commission move from a large AMC to small AMC? And if the small AMC doesn't perform, who ends up losing? The investor does. So that's one risk. Coming back to your pointed question, will it be a volume game? I think, yes, it has always been a volume game, but today the mutual fund industry, if measured as a percentage of AUM for India, it is just 16%. So our AUM is only 16% as compared to the GDP of the country. The global average is 63%. Brazil is above 80%. Brazil, okay, which is supposed to be one of the BRIC countries, which we used to use that nomenclature, with India as an economy. If you look at US, the mutual fund AUM as a percentage of its GDP is 140%. So we're just scratching the surface. So will it be a volume game in the future, irrespective of this paper or no paper? It is going to be a volume game in the future because we're still scratching the surface. So I personally think that my fear is anything which you're trying to solve should not create a further problem, because AMCs, if distributors start giving you smaller AMCs to an investor, that could pose a larger risk than a small scheme of a big AMC which is capable.
Sure. Just for the viewers out there, we've been speaking about TER, that is the total expense ratio. And now, what is TER? It's just a percentage of the scheme's corpus that the fund house usually charges towards as expenses. Now, presently, a slab-based TER is applicable for various categories in schemes in terms of equity, in terms of debt, in terms of hybrid, in terms of, the solution-oriented based schemes. But overall, if you talk about the other proposals that have come in from SEBI, SEBI has also proposed the idea of performance-based TER. How difficult do you think the implementation would be? I'm going to come to you, Anand, first.
See, at times we focus more on the penny and focus and forget the pound. I feel that we should not be penny foolish and pound smart. We should be rather penny foolish and pound smart. So, biggest issue with the expense ratio, which I feel right now, is quality of the advice or quality of the stock selection should not be impacted from fund houses side, especially because now they will have smaller amount to cater. So obviously a good thing need good advisor, maybe need good fund manager, good team, good research reports and stuff. For that you need money. So it should not happen that quality is getting disrupted. This is one important point. Finally, if we talk about investors as such, they will enjoy, but we will have to see the whole perspective that how this is actually getting impacted. And if we talk about performance based advisory fees, I feel it is good, provided that it is not misused. It can be misused. For example, suppose if there is a fund manager who want to take higher management fees and they are taking some risky calls, so there will be years they will be charging at the highest rate, and there might be series of years when they'll be underperforming and maybe disturbing investors experience with mutual funds. So this is something which we need to take care, that there has to be strict upper limit, plus there has to be strict guidelines which is to be followed, and then it will make sense to charge a performance based fees. Right now we see a lot of PMSs charging performance based fees and underperforming just because they are trying to overdo stuff, maybe try to take some risky stocks or maybe take some risky bets just to outperform the market by a large margin. So this is something which we have to take care of.
All right, so I'm just going to ask a similar question to Avinash out there. What do you make out of the idea of the performance-based TER? How does that ring to you?
SEBI has made the performance-based TER more of an experiment and optional. So I'm just speculating and guessing here, but my guess is only the newer or smaller AMCs might do much on this front. Why would a big AMC bother about all of this? They have their brand name. It's someone who's upcoming who will want to shine in some way or stand out who might use this. So I don't see it making a very big difference to the overall business as of now. That's my guess. And I personally am a big fan of passive index funds like the Nifty 50 index fund. So it doesn't make much difference to my life. And I don't think it makes a I don't think it's going to make a huge difference to the mutual fund space, active space also in the short to medium term.
Avinash, that makes the two of us in that case, when it comes to the passive funds out there, index funds. But another proposal that has been floated by SEBI has even proposed that AMCs can be allowed a limited membership of the stock exchanges to cover their transaction costs. This is one of the other, proposal that has come from the consultation paper. Feroze, weigh in on this one. What do you make out of it, and overall, your concluding remarks on it?
Nikki, I think it's not a great idea because you should always look at value and rather than cost. Now, what happens is there are 39 AMCs, 149 active fund managers. These guys are serviced by sell-side analysts who are hired by brokers. If I'm not wrong, there are more than 1,000 sell-side analysts who service this 39 asset management companies in the lieu of the variable cost in terms of brokerage. When this goes away, if an AMC becomes a competitor to an institutional broker, then why will that person give the research? So will the performance for the investor get impacted? I surely think it can get impacted because there's huge talent in the sell side analysts. So an AMC which has only 5,000 crores is not going to be covering 500 stocks. Today we have 396 stocks, more than 3,000 crores, and below the mid cap category. The small cap universe is completely being covered by the institutional broking, largely. Of course, large AMCs might have their own coverage, but I think that smaller AMCs, at least 25 of the smaller AMCs out of the 39, rely on in the small cap space the analysts, sell side analysts research reports. And last 5 years back, we had only 250 stocks. Today, we have 396 stocks. So the coverage will go down. If coverage is going to go down, the newer ideas are going to be harder to find. So brokerage, of course, for arbitrage fund, for example, this is a brilliant idea because arbitrage is going to be buying and selling. If the brokerage is negligible, by having a membership yourself on the stock exchange, it's good. So that's where I think we have to understand what kind of arrangements will AMCs have with brokers in terms of fixed fee if this gets implemented. But I think we'll be looking at cost more keenly than the value which is being delivered by this talent in terms of sell side analysts. And these are sharp brains of India who are supporting for no fixed cost to the asset management companies.
Right. So overall, how do you view this overall proposal coming in terms of consultation paper from SEBI? You think it's a good move coming in for the unit holders, Feroze, or you think otherwise? How would you like to see this overall?
I think objective, very, very good. Methods, 90% very, very good. Some degree of tweaking. I'm glad that SEBI is hearing and has a due date to submit responses. But I think the objective is great. Transparency is great. Any distributor, for example, who's doing ethical work is not going to get impacted more than 3, 4, 5% of the revenues. AMCs will get impacted, but I'm sure AMCs will find their ways. They're sharp professionals who are running their businesses. But I'm very happy overall. But I think these 2-3 important risks for the investors have to be addressed. Losing all the sell-side analysts over the period of next 5-10 years could have large impacts to the 380 active funds, which is not a great idea. Maybe if implemented as is, where is in the consultancy paper.
All right. Avinash, how about you? How are you reviewing it overall? Clearly, Feroze has spoken about the risk that he sees from this one. How do you rate this particular consultation paper and the proposals that have come thereby?
I think the consultation paper is extremely positive. I overall think it's extremely positive. I think, as I mentioned, getting everyone to pay this, all customers of the AMC to pay the same fees, I think is extremely positive. I think good that SEBI is doing it via consultation paper. Such large changes should be done as a consultation paper first, because there'll be always some nuances the regulator could miss out and the industry can point it out. Overall, I think it's positive. I think just one small, I think it's very brave on the part of the regulator already to do something like this. I would just mention one step even braver than this. I think currently there's still small distributors, I understand, get sometimes lower commissions than bigger distributors. And I think that's something the SEBI should look at next, that if Mr. X retired person is sharing 1% of his investment over every year, which is 26% of his investment or his money over 30 years. Why should that money not go to his distributor? Why is only half of it going to his distributor and half going to some bigger AMs, bigger distributor who can negotiate harder and get it out of the AMC?
Right, that's the distributor level concern that we're looking at, Avinash. And Anand, your final remarks on how do you see it? Are you viewing it very fairly enough? In the sense, are you very optimistic about, positive about this consultation paper that has been floated by SEBI?
See, objective is really good. Execution is important. And smaller distributors, especially the B30 part, need some relaxation because a lot of smaller and newer distributors will be facing a lot of issues because they won't have that leverage to work harder. So
That's exactly,
B30 relaxation.
Anand, that is exactly what I was trying to point at the start of the discussion. Do you think with these, distributors at the B30 level, they'll be disincentivized to kind of go ahead and push out those products there, and thereby that will be a bit of negative coming in for the retail investors out there who otherwise wouldn't know about these schemes in the first place?
Maybe possible because it will be really hard for a new distributor to survive with such hard regulations. Even we are seeing that the B30 any which ways is not coming from last few months, and for smaller distributor B30 was an important part and an important incentive which was actually taking care of his expenses. Right now it might be really difficult for him to survive, and at times it might happen that some of the distributors might end up shifting to some insurance product or maybe selling some traditional insurance just because they need to take care of their basic expenses. So this is something which is need to be taken care of. Especially the B30 part has to be solved as soon as possible. And I think B30 should not be stopped. It is absolutely okay to give B30 any which ways the amount was not that big.
All right, gentlemen, we'll leave it at that. Thank you so much for taking out the time and speaking to us.
Thank you so
Thank you.
much.
All right, with this, it's a wrap. Well, we're seeing the impact coming through for distributor levels in terms of B30 cities out there. The impact is a little too higher. We're seeing a bit of hit coming in from AMCs. Of course, the margins are going to be a bit compromised. Remains to be seen if the volume game can pick up and provide the solace out there for the AMC. But for the unit holder, on the face of it right now, it looks to be a little bit of positive. But in absence of the required support coming in from the distributor segments out there, that could be affected a little bit. But with this, it's a wrap. And thank you guys so much for joining in.